Hi, David Selden here, Managing Advisor over at Mountain West Retirement and the creator of the Retirement Roadmap Planning System. Today, we're going to talk a little bit about maximizing opportunities during these interest rate fluctuations. So, the purpose of this training is that to help you really leverage the changing interest rate environment. Look for ways to optimize your financial planning strategies, optimize your investments, and of course, debt management always comes into play. So, let's talk for a second about interest rate fluctuations. When we talk about interest rates, what is it we mean? What's their role in the economy? And to a large extent, when we talk about interest rates, they're going to be a function of actions that the Federal Reserve has taken in managing the monetary supply here in our country. So different things can really affect how interest rates fluctuate, things like inflation, economic growth, rapid economic growth, and of course, as I mentioned, the Federal Reserve, the central bank policies that can really cause rates to rise or fall. So why is it that important to financial planning? Well, these changes will impact your savings, impact your investments, and impact any debt that you might be carrying. So let's spend a minute on the debt management piece. So there's a couple different types of debt that you're likely exposed to: fixed and variable rate debt. In fixed rate debt, that means that interest rates aren't really going to affect those locked in fixed interest rates. That might be on a mortgage, that might be on a personal loan. But if you've got a fixed rate, the fact that rates are going up is not going to affect it that much. If you've got a variable rate, say for example on a adjustable rate mortgage, you've got to really kind of keep an eye on and review those variable interest rate loans, mortgages, things like HELOCs in a rising rate environment. Today we're not in a rising rate environment, so that's good news, but eventually rates will go back up and you'll have to keep an eye on those. So you may want to look at possibly refinancing some of those loans. We're moving into a lower rate environment. Rates will probably go even lower from here. So it might be time to take a look at refinancing some of those variable rate loans. A good rule of thumb for variable rate loans is once you have seen the rates drop 3/4 of a percentage point or 75 basis points from wherever you are currently, it's a good time to start taking a look at refinancing those. So, you want to take a look and review your debt portfolio to assess if any refinancing opportunities make sense, or look for ways to lock in a fixed rate so that you don't have to be concerned about the move so much over time. Now, on the investment side, there's several things to consider. The first of which is what happens with bonds and fixed income securities. So there's actually an inverse relationship between interest rates and bond prices. So you need to use different strategies in both rising and falling interest rate environments. So when rates are going up, you want to keep your bond portfolio on the shorter end. They're called shorter duration bonds, short-term bonds, or possibly bonds that have inflation protection. The Treasury offers TIPS, which are Treasury indexed, inflation protected securities. They're a short-term investment. So in a rising rate environment, keep your duration short. When rates are falling like they are now, actually long-term bond portfolios, long-term individual bonds are actually going to perform better because of that inverse relationship. The price of the underlying bonds is going to increase as rates come down. So many of us hold stocks, equities, stock mutual funds. The impact of rising interest rates on growth stocks, which are smaller companies that are much more sensitive to borrowing costs, is much more significant. So in a rising rate environment, growth stocks can tend to have higher borrowing costs, and thus value stocks, companies that have high book value valuations, pay good dividends, those value stocks will tend to be more stable. So in an interest rate environment that's rising, once again, financials, banks, insurance companies, and energy stocks tend to benefit from rising interest rates. Once again, financials and energy benefit from rising interest rates. Growth stocks tend to be more sensitive because of the borrowing costs during rising rate environments. So overall, the thing that you really need to do is I encourage you to look at a diversified investment portfolio to help protect yourself or insulate yourself against certain interest rate volatility. So, savings, cash management accounts. During rising rate environments, these high yield savings accounts, high yield money markets may provide a better return on your savings and CD money. You may also want to take a look at adjusting your emergency fund strategy. So when interest rates are low or going lower, like they are now, look for higher yielding options. When interest rates are rising, be more strategic about how you position your cash and once again keep it in shorter duration investments. So how do interest rates and how do these fluctuating interest rates affect your retirement planning? Because that's what we do here at Mountain West Retirement is the real retirement roadmap and designing comprehensive retirement plans for our clients. So the impact of changing rates on the retirement end is primarily focused on bonds and annuities. We talked about the inverse relationship of bond prices. But it creates opportunities in the annuity space. Higher interest rates can make certain annuities, whether they be fixed or indexed, much more attractive. So you can even use strategies like laddering annuities to capture higher interest rates over time. So that's how it affects your investments. That's how it affects your debt. You can the key takeaways from this conversation are really this: for you to review any debt you have, whether it's fixed or variable rate debt. Take a look at your debt portfolio. It's a portfolio too. Look at your investment portfolios to adjust the duration of your bonds, whether it be individual bonds or bond funds and bond portfolios, or different sector exposure you may have in your bond portfolio. You want to look at saving strategies to take advantage of high rate savings or CDs. So your short-term money, there may be opportunities for you to get into high yield savings accounts or short-term CDs that have increased interest rates. So just like a lot of us working from home today, and as you probably heard, we've got a few guest dogs here in our home today, but the whole purpose of this training was to provide really clear takeaways and action points for how to adjust your financial strategies in response to interest rate fluctuations, whether it be for debt management, investing, or retirement planning. For more information, feel free to contact me at Mountain West Retirement. Once again, I'm David Selden. I can be reached at 720-907-8260 or dave@mwretirement.com. I look forward to having the opportunity to help you along your journey to a real retirement.